Hello students, welcome to my class. This is Professor Vincent Usaya, and this is the presentation of part 4 of chapter 20, accounting for pensions and post-retirement benefits. Part 3, we talked about how to use the worksheet to come up with the figures that we need to make journal entries for pension expense. In part 4, we are going to do likewise. The only difference here is we are going to tweak this by zeroing in on prior service cost component of pension expense. And also we are going to talk about how to report a pension in our financial statements. So let's take a look at the facts for the illustration. So the following defined pension data of our corporation for the year 2014. The projected benefit obligation at the beginning of the year before amendment was $560,000. The planned asset was $546,200. The pension liability is $13,800. Obviously, the pension asset is less than the projected benefit obligation by $13,800. On January 1, 2014, the corporation, through plan amendment, grants prior service benefits having a present value of $120,000. The settlement rate is 9%. The service cost for that current period is $58,000. The contributions, that is the funding, is $65,000. The actual return on plan asset is $52,280. The benefits paid to retirees is $40,000. I want you to take a note here. The benefits that we pay to retirees in this current year obviously is different from the service cost of the current year. So the prior service cost amortization for this year is $17,000. So let's take a look at the pension worksheet, or let's take a look at how we are going to use the pension worksheet to determine the amount that we need to make the journal entries for pension expense. So let's take a look at what we have here. So look at the first row. We have on December 31st, 2014, we have the projected benefit obligation is $560,000. The planned asset, as we indicated, is $546,200. So from the get-go, we have $13,800 underfunded a pension plan. So the prior service cost here, as we indicated, is $120,000. So the prior service cost obviously increases the projected benefit obligation. All right. Now, of course, we have a column here for the prior service cost. So then take a look at the balance January 1st, 2014. So at the beginning of the year, we have projected benefit obligation of $680,000. We have a planned asset of $546,200, obviously underfunded. Now let's take a look at the service cost for the current period. Annual pension expense is $58,000. That is the service cost. Obviously, that increases the projected benefit obligation. The interest cost increases the annual pension expense, and of course that also increases the projected benefit obligation. The asset return of $52,280 decreases the annual pension expense. It's one of the components of the pension expense, and of course that increases the planned asset. The amortization of the prior service cost, $17,000 in this current year, of course decreases the prior service cost. and of course it's part of the annual pension expense. We made a $65,000 contribution. Of course, here's the cash column. We have $65,000. Of course, the $65,000 contribution that we contributed to the plan increases our pension plan asset. Now, the benefits paid to the retirees this year, of course, decreases our projected benefit obligation, and it also decreases our plan assets. All right? So, moving along, the journal entry, take a look at this. The annual pension expense is $83,920. The price service cost here is $103,000, but we paid only $65,000. So therefore, we are short by $121,920. Take a look at what happens. The $121,920 plus $13,800, of course we were short from the get-go, gave us $135,720. So therefore, if you take a look at the last two columns, you see the difference is $135,720. So we have underfunded pension plan of $135,720. So let's take a look at how we make the journal entry. Very easy. We use the information from the worksheet just like we did in Accounting 110. Use the information from the worksheet to prepare the financial statements. Here we are using the information in the worksheet to prepare the journal entries. So the pension expense is $83,980 as computed. Other comprehensive income is $103,000. The pension assets liability is $121,920, and the cash that we cough out is $65,000. So moving along, let's take a look at the accounting for expected gain or loss. So here we said that unexpected swings in pension expense can result from sudden and large changes in the fair value of plant assets and changes in the actuarial assumptions that affect the amount of the projected benefit obligation. So we did explain this previously. Now, so the question is, what is the potential negative impact of the net income on these unexpected swings? The volatility. So the profession decided to reduce the volatility by using the smoothing techniques as you learn in your STARS class. So they have different methods of doing that. The smoothing unexpected gains and losses on planned assets. So companies will include the expected return on planned assets as a component of pension expense, not the actual return in a given year. Companies will record the assets gains and assets losses in an account called other comprehensive income, combining them with gains and losses accumulated in prior years. So these are the two approaches of smoothing unexpected gains and losses on planned assets. So let's take a look at so all along we have been talking about how to account for pensions, or how to record or the accounting treatment for pensions. So we're talking about recording, the journal, the ledger, so on and so forth. Here we are talking about reporting pension plans in financial statement. So the reporting, here we are dealing with financial statements. So we say within the financial statements, number one, we have to recognize the net funded status of the plan, overfunded or underfunded. Number two, the classification of pension assets or pension liability. Then the aggregation of the pension plans has to be done. The actuarial gains and losses price service cost has to be taken into account, has to be reported as well. So here are, part of reporting, as you know, is we have to have disclosures. So there are certain line items on the financial statements that must be disclosed. One of them, obviously, is pension. So here are 3 or 8 different things that we have to take into account in the notes to the financial statement. Number one, major components of pension expense. Reconciliation showing how the projected benefit obligation and the fair value of the plan assets change. Then number three, the rates used. Number four, a table indicating the allocation of pension plan assets. Number five, the expected benefit payments. Number six, the nature and amount of changes in the plan's asset and the benefit obligation recognized. Number seven, the accumulated amount of changes in the plan asset and benefit obligations. And number eight, the last, is the amount of estimated net actuarial gains and losses from prior service costs and credit, so on and so forth. So that is the conclusion of chapter 20, accounting for pensions and post-retirement benefits.